Good day, ladies and gentlemen. I'm Amar Kumbhan, your webinar coordinator. Thank you for standing by and welcome to BMR Advisors webinar on Foreign Trade Policy 2015-2020. As a reminder, for the duration of this conference, all participants' lines will be in the listen-only mode. There will be a Q&A session at the end of today's presentation when the participants can ask questions. To ask a question, the participants may type the question during or at the end of the presentation in the Q&A box and send it to the panelists. The panelists will address the question during the Q&A session. Now I would like to hand over the proceedings to Himanshu Tiwari, Partner Indirect Tax, leading the Customs and Foreign Trade Vertical at BMR Advisors. Thank you, and over to you, Himanshu.
Thank you, Amar. A very good morning, ladies and gentlemen. Welcome and thank you for attending this webinar on Foreign Trade Policy 2015 to 2020. We will start the policy discussion, and this is the first time that the Foreign Trade Policy has articulated a 5-year vision and the logic as to why certain provisions and certain instrumentalities are being introduced and what is the larger context in which the foreign trade policy is operating. Mainstreaming the foreign trade policy in the larger economic policy of the country is one key differentiator of this foreign trade policy. Policy clearly articulates the goal that India's export by 2020 should be $900 billion, which currently stands at around $460 billion. So doubling the export is the target, quantitative target. The method of achieving that goal, the government plans to do it by mainstreaming the trade policy and following the whole of government approach. And these two words, mainstreaming and whole of government approach, have been, it is good to understand what it means. The foreign trade policy, till now, it is being understood that the foreign trade policy was being driven by Ministry of Commerce, but didn't have support of, or was the interlink between the Ministry of Commerce objective of foreign trade policy and the larger objective of economic policy. The linkages were either not there or were not functional, or they were not operationalized. This policy lays out details in communication and connectivity between various departments and the stakeholders in foreign trade, and tries to bring alive the energy of each element who have a role to play in the foreign increasing the India's role in global trade. Foreign trade policy very clearly also lays out the method of creating synergy between the trade policy objective and government thrust on Make in India, Digital India, Skill India, and ease of doing business. The Make in India campaign, and most recently the Prime Minister, the Honorable Prime Minister, was in Hanover because India is one of the partner country of Hanover Trade Fair, and on all national and international forums, government is going on record to say that Make in India campaign is for manufacturing in India and to manufacture for the world. To make it happen and to improve the ease of doing business, digitization has a key role to play. digitization is a great leveler and the documentation moves much faster. The connectivities work much better. So digitization has a key role to play in this. And Skill India is again an integral part of this campaign. If Make in India has to succeed, we need to be able to skill the labor in India to be able to support that Make in India campaign. The policy also focuses the strategy for achieving this target has two critical elements. One is a focus on the key markets for India's export and the key products which are competitive, which are sought out, and how to make it reach out to a larger market, or in the given market where we have the access or where the market potential is there, which new products or a greater thrust on a particular product can help increase, meet the objective of the foreign trade policy. Promotion of brand India is a key. The minister has gone on record to say that going forward, the financial incentives and subsidies will be rolled down and India's export will be critically relying on competitiveness of Indian products. And two key elements of competitive products and services are the quality of the product and branding of the product. So branding of the product and services from India and zero defect manufacturing are two integral elements of making the Indian products and services competitive in the global context. Reduction in transaction cost through improving ease of doing business in India through digitization will be a key part of the strategy. For the first time, foreign trade policy, in the past we have seen that the foreign trade policy has been an annual exercise where changes in the foreign trade policy were being announced on a year-by-year basis. This is the first time that government has said that this policy framework will be available and stable for the next 5 years. There will be a mid-term review at the end of 2.5 years, but broadly the framework will continue to be the same. Based on feedbacks of operationalization, if certain procedures needs to be tweaked, they will be tweaked, but the larger context of the policy and the thrust of the policy will continue to be the same for next 5 years. This gives a lot of visibility and certainty to the policy measures and will help businesses to plan their export within this framework on a long-term basis. So government through this measure is trying to bring the element of strategy in the export promotion. The trade facilitation and transparency and simplification of processes are key to enabling the policy to achieve its objective. Coming to the key features of the foreign trade policy. The foreign trade policy statement lays out vision, goals and objectives of the government for the next 5 years. The chapter 3 of the policy, which used to be the traditionally export incentive schemes, that has been rationalized and a more scientific approach. In the past, it was more perceptive approach to quantification of export incentive schemes. This time, government has laid out clearly as to what are the basis on which the export incentives are being quantified, and a greater transparency on the quantification of export incentive schemes gives a lot of visibility for the industry to make representations, to bring out the fact if their product, if the particular market fits into the larger scientific logic of the export incentive schemes, government will be ready to consider it. Product diversification relies upon the focus of the product diversification supports labor-intensive industry and the employment-generating sector. The market diversification strategy clearly looks beyond the look east policy of the past and tries to focus on the traditional markets, which is US and Europe, and the emerging markets of 139 countries. The emerging markets, as per the current statistics, the emerging markets contribute to around 56% of India's export, and the traditional markets contribute around 30% of India's export, while the balance 14% is contributed by the other markets. Considering the large base of 56% of contribution coming from emerging markets, the policy lays emphasis on how to expand the base of export to emerging markets and the traditional markets. This could be achieved by giving thrust to defense-related exports, high technology exports, auto ancillaries export, and the pharma sector. So there are clearly identified industries where government sees that giving trust and support to these industries would contribute to the increase in export potential from India. Foreign trade policy for the first time has also brought out the concept of import rationalization, which primarily means that the import data will be continuously monitored to see which items from which geography or market is coming to India, and there are distortions, and if there are any non-tariff barriers or controls needs to be put in place to rationalize the import. In the past, we have seen that import of gold has been one of the key elements which has surged in past 2 years, and government has tried to put in controls to rein in the import of gold. But that has been one item in the past. Going forward, if this analytics works, we would see time to time intervention from the government to bring out rationality and to reduce trade distortions by any sudden surge which is detrimental to India's economy. So we'll see how it plays out, but this is the concept we need to, industry will watch out for. No. Transparency and efficiency through trade facilitation and initiatives and building e-governance capabilities is the thrust area, not only for foreign trade policy, but also for improving governance overall. That is a larger objective of the government. Foreign trade policy is also an integral part of that larger initiative. Now we'll come to the export incentives specifically, and this is something of interest, and changes in the Chapter 3 export incentives has drawn a lot of attention from the industry in last 15 days of the policy. what we have seen from a rationalization perspective is in the past, the Chapter 3 export incentives had various policies and various bases on which the export incentives like focus market, focus product, status holder certification, market link focus product scheme, agricultural infrastructure scheme, Vishesh Krishi Gram Udyog scheme, all those schemes have been put together in a more rational and simple format in the new merchandise export from India scheme. The quantum of benefits also have been rationalized and made more predictable. In the past, we have seen that certain businesses for certain products and the markets were able to realize up to 7% of the FOB value of export as the incentive. However, going forward, the incentives have been capped at 5%. So there are three ranges. 2% is one rate, 3% and 5%. These are the three rates. And depending on the matrix of product and market, these credits are eligible. There are around 5,000 line items have been covered under the MEIS scheme. Lot of new items have been added to it, and the policy says that it has added around 800 line items of the defense sector to this scheme. Government will be closely monitoring the cash outflow out of under these schemes and see whether it requires any further calibration midterm. The 5% incentive, which is the highest of the band of incentives which have been made available under MEIS, is made available generally to the export which has high domestic content and value addition, and also high degree of labor utilization, and has a potential to generate employment in India. The minister in his statement has gone on record to say that export from SEZ units will also be eligible for MEIS benefits. However, the statement went on to say that it will be available to MEIS, which is part of the policy, while the SEIS benefit has been a matter of discussion and debate. DGFT, Mr. Praveer Kumar has been on record to say that we may expect a corrigendum to the foreign trade policy, which the intention would be to make SEIS benefit also eligible to SEZ units. But till now, that appears to be a work in progress. We have not seen a corrigendum or a notification in this regard. So for now, MEIS scheme is eligible to exports from SEZ unit. Benefit of duty credit schemes under MEIS in case of exports through courier also has been made available. With growth in e-commerce and lot of export happening through the courier mode of transport, which in the past was not eligible for some of the Chapter 3 export incentives, will now be eligible on a going forward basis for those export incentives. This would be a great help to the e-commerce sector and also to the courier sector, where the smaller quantity and merchandise export, which are smaller in quantity and a limited quantum in terms of value, will now we may see a shift in those exports happening from the traditional transport channels to the courier mode. Coming to the SEIS benefits. Okay. So for this MEIS also, we need to be mindful that there are ineligible category of exports and exports from EOU, EHTP, STP availing direct tax benefits will not be eligible for exports. It is for the business and to examine that most of the EOUs, STPs anyway are not availing direct tax benefit after the sunset clause became applicable in 2011. So this ineligibility may only impact those businesses who continue to use direct tax benefit, if any. In absence of that direct tax benefit, the EOUs will be eligible for MEIS related benefits. Supplies from DTA to SEZ unit is not eligible. Deemed export will not be eligible. Export of imported goods will not be eligible. FTWZ supplies are specifically excluded, and export of restricted or prohibited items fall in the ineligible category for MEIS. For the SEIS scheme, it is a replacement of the erstwhile Serve from India scheme. The credit of Serve from India scheme used to be pegged at 10% of the export value, while there were certain restrictions on utilization of those scripts and the items imported using those credit scripts. The SEIS scheme has changed the terms and conditions of the Serve from India scheme. The quantum of the benefit has been reduced to maximum up to 5%. So there are incentives for services export which are pegged at 3% and at 5%. Notified service providers located in India would be eligible for this benefit. Around 40 services are covered in this, and the classification of the notified services is also now being aligned to UN classification of products version 1.1. So there's a 3-digit, 4-digit and 5-digit classification of these services. The UN Statistics Department has an explanatory notes describing the services which would be qualified under these categories. It will be important for the businesses to understand the code and the content and the nature of the services that would qualify for these benefits. Benefits are under SEIS are linked to net foreign exchange earning minus the total expenses, and there are clarifications as to if the business has services export as well as manufacturing, then the foreign exchange earning and expenses of the services sector would only be considered for the purpose of calculation of net foreign exchange earning. It is important to note that the service providers has been defined under the Foreign Trade Policy para 9.51. There are 4 categories of service providers, and this definition is aligned to the global definition where there are 4 modes of services export, and for the purposes of SEIS, mode 1 and mode 2, which is the cross-border trade in services and consumption of the services abroad, are the 2 modes which are considered to be eligible. There is a list of ineligible category of exports which include foreign exchange remittances related to financial services or earned through contractual or regular employment abroad, exports by SEZ, EOU, STP or supplies to such units is currently the policy says that none of these category of exporters would be eligible for SEIS benefits. Industry will have to keep a watch on the DGFT's statement that SEIS benefit would be made eligible to the SEZ category. But for all the other category of service providers, whether it is STP units, whether it is EOU units or EHTP, the SEIS benefit will not be eligible. It makes a case, and we'll discuss it later in the presentation. It makes a case for the service exporters and STP units, considering the eligibility criteria, to see whether it makes business sense to continue with the compliances under the STP scheme and not be eligible for SEIS, or explore the option of exit from STP scheme and consider realizing the benefits under the SEIS scheme. While considering these options, it will be very important for the businesses to be mindful that SEIS scheme, the data under the SEIS scheme as to what will be the quantum of financial incentives which will flow out of this scheme is not readily, there's no track record for the government to calibrate and quantify the benefits. So the public notice in this regard goes to say that government will review the SEIS related incentives within 6 months. So the current rates and the notified categories will be eligible for exports till September 31st. October 1st, government plans to review the qualification, the quantification and of the SEIS incentives. Telecom sector is excluded from SEIS schemes. The common feature of MEIS and SEIS scheme, which makes it a very promising feature of the new foreign trade policy, is that the scripts and the goods imported under the scripts are freely transferable. It's a very progressive and beneficial change. It will make it makes a very compelling case for the businesses to explore the possibility of usage of MEIS and SEIS, which can directly contribute to the bottom line of the export related business. The utilization of the script has also been expanded to include payment of customs duty on the imports, excise duty on domestic procurements, and service tax on procurement of input services. Debits made to the script will be entitled for duty drawbacks and net credit. And currently it says that the registration of the scheme will be at the port of export. We will need to examine how it will play out, and we'll wait for some of the procedures to be notified, that if the script has to be registered at the port of export and the holder of the script wants to utilize the script for payment of service tax on procurement of services, how will it happen? Will it happen that the scripts will be registered at the port of export and the holder of the script will have to ask for release advice from customs addressed to the service tax department, and then the final debit happens at the service tax department? Some of the details will emerge, but it will take a while before the first SEIS scheme is issued, and the utilization will be consequent to the issue of the SEIS scheme. The SEIS scheme currently, as it looks, that it's an annual once in a year claim, which will be at the end of the year, that the service exporters will be able to claim this benefit. However, we will keep a watch on it, and whether it will be only once a year that the exporters will be able to claim it, or on a periodic basis, a claim of SEIS benefit could be possible. The procedure has been the customs notification, the central excise notification, and the service tax notification has been notified for the usage of this script. As per the details of these notifications from CBEC, the services to be registered, the scripts have to be registered with the Customs Authority at the port of export. The scripts will be presented for debit by the customs officer based on the procurement invoices. The customs officer shall debit the taxable amount on the reverse of the script holder to present the script to the excise officer. So the control of the debits of the script will lie with the customs at the port of export, while the scripts might get utilized at the respective excise jurisdiction or the service tax jurisdiction of the user. The transition provision for the MEIS and SEIS also have been notified. We have tried to give a snapshot of a comparative analysis of the scheme, the MEIS and SEIS scheme, to the schemes of the past, just to bring out the fact that on the parameters of transferability, payment of excise duty, payment of service tax, Senate credit, duty payment on in cases of export obligation defaults, all the past schemes used to have various conditions around these parameters. MEIS and SEIS schemes has a simple parameter that under all the conditions the scripts can be used. The status holder incentive scheme has been discontinued. Nomenclature of the trading houses have also changed from to 1, 2, 3, 4 and 5-star export houses. The denomination of export performance has been shifted to US dollars. The 3-star and above status holders will be shall be entitled for benefit under the accredited client program of CBC. 3-star and 4 stars and 5 stars manufacturer will be eligible to self-certify their manufactured goods. So the country of origin certificate can be issued by the status holders above 3-star category, and they will also be eligible for quick and fast track fixation of input-output norms. So the major change under the foreign trade policy has been the Chapter 3 benefits. The duty exemption and remission schemes of advance authorization and duty-free import authorizations, there are no major changes. Their trade facilitation measures have been introduced, have been committed for advance authorization and duty-free import authorization schemes, where online applications will be enabled in due course of time before December 2015. Export obligation period continues to be limited to 18 months. However, for a specific category of high technology, defense, military, aerospace and nuclear energy related sectors, export obligation period has been made liberal at 24 months. Imports under advance authorization schemes, they will be exempted from customs duty and anti-dumping. Under the EPCG scheme, again no major changes on imports made under EPCG scheme, import of capital goods made under EPCG scheme. However, for the domestic sector and to support the Make in India initiative, the capital goods sourced under the EPCG scheme will be pegged with lower export obligation up to 75% of the normal export obligation, which is 6 times the duty saved on the procurement of capital goods. So effectively, the export obligation on domestic procurement will be 4.5 times the duty saved amount. Certain flexibilities have been introduced in terms of the requirement of submission of chartered engineer certificate, where it is said that chartered engineer certificate will not be required. Installation certificate will not be required for the capital goods installed in the factory, and it will be sufficient to produce a chartered engineer certificate. There are certain incoherency and disconnects between the handbook of procedure and the policy on this. We'll wait for the clarification on this procedure. As regards the EOU scheme, scope of the scheme continues to be the same, where the objective is to promote export, enhance foreign exchange earning, and attract investment with support to generating employment in India. Validity of the LOP, which used to be 3 years in the past for starting the operation, has been reduced to 2 years, and it will be further extendable to 1 year if required. Time period for realization of exports produced has been reduced to 9 months. It used to be 12 months in the past. Sharing of infrastructure facilities among EOU permitted on case-to-case basis. Inter-unit transfers. So, inter-unit transfers, simplified procedures. These are to bring simplification, and also the capital goods under the STPs, under the EOUs or the STP schemes can now be used for training purposes. And this is meant to support the Skill India initiative of the government. Fast-track clearances of the EOUs with more than 10 crores of export has been introduced, which the limit for this fast-track clearances used to be 15 crores in the past. There have been certain changes in the deemed export incentive benefits also. The purpose of the deemed export scheme is to provide a level playing field for the domestic manufacturers. Benefits of the deemed export benefit has now been categorized into 2 baskets: supplies made by the manufacturers and supplies made by the main or the subcontractors. The eligible projects funded by multilateral or bilateral agencies have been reduced. The supply of goods to UN and other approved international organizations for personal use have been added to the entitlement for the deemed export benefits. Certain new conditions have been introduced around claim of refund of deemed drawback, and the new conditions goes into say that Senvet credit or rebate not availed by the supplier. If Senvet credit has not been availed by the supplier, duty drawback shall be admissible at all industry rate of drawback, while if Senvet credit has been availed, duty drawback will be available only on the van rate of drawback. Third-party supplies will not be eligible for deemed export benefits, and supplies of domestically manufactured goods by Indian subcontractors to Indian or foreign-made contractors will be eligible for the deemed export benefit. For the first time, the policy has introduced a risk management system where 10% of the cases where deemed export benefit has been claimed will be subject to internal audit by DGFT. The process of internal audit will be notified in due course of time, but an audit by DGFT is a fresh process which has been introduced, And as we see the degree of facilitation increase in foreign trade policy, we would see this trend to strengthen, where the post dispersal of the benefits, introduction of audit mechanism will become pervasive. So this is beginning of a trend, and let us see how it plays out. Provisional grant of drawback claiming fixation of brand rate has been done away with. That brings us to the market diversification and strategy part of the policy initiatives. As we said earlier in the presentation, the category A and category B countries, which are the category A contributes 30% to the export from India, and category B contributes around 56%. Together they add up to 86% of the export from India. So deeper market penetration and in these two categories will be the focus for this policy. Product diversification has emphasis on pharmaceutical, chemical and electronics products, high value added products, defense products which have been defense products have found their inclusion in the MEIS scheme for the first time. Chapter 7 of the foreign trade policy has introduced, Chapter 8 of the foreign trade policy talks about trade facilitation and dispute resolution measures. So the 22 jurisdictions of joint DGFT has been authorized to receive complaints on export from India and be the nodal agency to try and coordinate for resolution of those disputes through coordination with the foreign embassies of the country of import and Indian missions in those countries. This will become a key measure of improving the experience of the importers of Indian products outside India. Coming to the last section of our presentation, where we wanted to share our take on the policy. In our view, the policy, this is a very synchronized policy where all the other elements of the government agenda has been kept into consideration at the time of drafting of this policy. Rationalization of and introduction of scientific approach to product and market diversification is a welcome step, and it brings transparency to the whole policy making exercise and quantification of export incentive schemes. Attempts to synchronize the trade policy to broader economic policy is a reflective of the objective of whole of government approach. So as the government reduces the quantum of export incentives under the Chapter 3 schemes, but the government is very clearly supporting a larger initiative and support of the government and all the stakeholders in giving a push to export through trade facilitation measures, through simplification of the schemes, and synchronizing all the other initiatives of the government to support increasing export from India. One of the key elements in the coming days to watch out for is some of the mega trade agreements that are being signed, that are being negotiated currently. The impact of those mega trade agreements on India's export is, government is keenly watching those developments and working out strategies to support Indian exports in the coming days, where the new architecture of trade is emerging globally. How to integrate in India's export with those changing architecture, and how to make the Indian exports more competitive will be an integral part of the watch out list for the government. Government is making a second attempt on making this SEZ schemes more lucrative for the businesses, and to that extent, exports from SEZ being included for MEIS and SEIS benefits is the first step in that direction. Going forward, we'll see the policy statement makes a mention that they will try and see how SEZ scheme can be made more lucrative. Government is thinking in those directions. We'll see all other policy measures that may be announced for SEZ schemes in due course of time. As we mentioned, case of exit from some of the traditional compliance burden schemes like STPI would be an important strategic move for the business. Delivery on expectations of business on efficiency, effectiveness and competitiveness is to be watched out. But all these policy initiatives has to work within the framework of the customs regime. So a key policy change and the fresh set of notifications and procedures which will support all these foreign trade policy related initiatives is expected from the customs CBEC, which will introduce customs at the border and the procedures related to it, how it will change. Recent newspaper and media reports have been mentioning about certain initiatives already being taken to operationalize the key recommendations of Tax Administrative Reforms Commission. Setting up of Directorate of Taxpayer Services at CBEC is the first step in that direction, and it will be watched out with keen interest by the government, by the industry. Simplification of exemption schemes is one area where industry would have an expectation from the government that multiplicity of exemption schemes which are linked to product category and use of the product, the nature of the importer, user and the importer, simplification of those exemption schemes and rationalization would be an important expectation from the industry. Easy, predictable and non-discretionary movement of temporary imports in and out of India would help in India's integration into global value chain. India should be able to organize trade fairs of the type of Hannover Trade Fair in Germany with ease and simplicity. The current regime does not go all out to support it. There would be an industry expectation on making some of these changes which makes temporary imports for the purpose of use in manufacturing, for the purpose of display and exhibitions in India, and simple procedures to take those products out of India will definitely go a long way in making Make in India and defense offset schemes more lucrative and implementable. With this, we come to the end of our presentation. Thank you so much for your patient audience. We will now begin with the question and answer session.
So, to ask a question, the participant may type the question in the Q&A box and send it to the panelist. The panelist will address the questions now.
So, we'll take the first question. The question is from Mr. Raghu from Bosch. And the question is, whether benefits under SEIS and MEIS benefit can be utilized by IT/ITAS units operating in STPI and SEZ units. It's a very good question, and the industry is looking forward. This is one key initiative of the government, and industry is looking forward to utilize these benefits. For now, the clarity is that MEIS benefit will be eligible for exports from SEZ units. For now, SEIS benefits are not eligible for SEZ units, neither for STPI units. However, DGFT has gone on record in a media statement to say that SEIS benefit will be made eligible to the SEZ units. The notification and the corrigendum has not yet come, but we are expecting that change. As regards utilization of SEIS benefits by STPI units delivering IT and ITAS services, it will be important for the industry to evaluate the underlying nature of the services that are exported from the STP unit and whether that service qualifies the UN classification, product classification criteria. Though the platform of that rendering of that service might be IT and ITAS platform, however, the nature of the services will become an important part to be evaluated. The second question is a request for clarification on BCD paid in cash or through the credit scheme would be considered for duty drawback subject to conditions specified in drawback rules. This would be applicable prospective or retrospective, since there were objections in the past while sanctioning or determining drawback of customs duty by utilizing certain Chapter 3 schemes. So we'll try to respond to this question. Industry has faced this issue in the past, which is also part of this facts in this question. BCD paid in cash or through the debit under credit scheme shall be eligible for duty drawback, and para 3.15 of the foreign trade policy articulates this clearly. The transitional provisions to Chapter 3, which is specifically covered under para 3.14 of the foreign trade policy, goes in to say that this provision will apply only on prospective basis and not for the imports made in the past. The next question is again around the Chapter 3 SEIS scheme under Mode 2, which is consumption abroad. The question reads, in SEIS Mode 2, consumption abroad, location of service consumer of other country should be outside India only? So our answer to that is yes. The definition of the service provider under Chapter 9.51 of the foreign trade policy covers services supplied from India to service consumer of any other country. Previously, it used to have a phrase after this that any other country in India, but now that definition to that extent has changed. And in India definition, part of the definition has been removed. So the current definition reads as services supplied from India to service consumer of any other country. Therefore, the location of the consumer should be in his or her country. This brings us to the end of the presentation. There are no more questions. We still have few minutes to go. If there are any specific questions, we'll wait for another 30 seconds or a minute to see if there are any specific questions or any supplementary questions to what we have answered. While we wait for the question for the 30 seconds, we'll also like to request you that in case of any other queries or follow-up queries that you may have in due course of time, after having deliberated over some of the discussions or soaked in the details of the presentation, we'll be happy to receive any queries on the email address corporatecommunications@bmradvisors.com. Please feel free to write to us on corporatecommunication@bmradvisors.com, and we'll be happy to respond to your query in specific around the foreign trade policy. Okay, considering that there is no further questions, we bring this session to a close. Thank you for your participation and have a nice day.
With this, we conclude the webinar on foreign trade policy by BMR Advisors. Thank you for joining. You may disconnect from the session now.